All right, welcome everyone. My name is Lisa Rodriguez. I'm the Director of Retail National Accounts here at Newview Trust Company. Today's webinar is going to be titled Doing Well While Doing Good, Value Aligned Multifamily Investing. And just to get a quick housekeeping done here, we do want to confess that we are not lawyers or CPAs. We are in fact a non-fiduciary, and so everything provided today is strictly for educational purposes. And you are encouraged to consult with your attorneys, accountants, and financial advisors before entering into any type of investment. Where does Newview fit in? We are a custodian and we custody IRAs for clients that want choice, alternative investment options. We've been in the business for 17 years. We're located here in Florida and we custody $1.4 billion in client assets. And our three uniques are being simple. We pride ourselves on being available, so much so that we talk about it every Monday in our staff meetings. And so far for the last 5 weeks, we have been at a 99% answer rate. So again, very, very important to us to be here for our customers and also pride ourselves on being responsive. So building relationships and just growing with our clients. So I'd like to introduce our speaker. His name is James Bryant. He is a PhD and a professional engineer. He is a certified professional life coach, author, and multifamily real estate investor. He is going to be speaking today on multifamily investing. And without further ado, here you go, James.
All right, Lisa, thank you so much for this opportunity to come and talk to you guys. I know we're getting some things set up as well administratively, but I want to practice the Q&A. We've talked about doing the Q&A during the presentation. And so if you could you please type in either the chat or the Q&A and tell me where you're from? Okay, all right, Greensboro, North Carolina. Gainesville, Florida, Jacksonville. Now, is that Jacksonville, North Carolina or Jacksonville, Florida? Chapel Hill. All right, great. Well, thank you guys for joining me. I'm looking forward to kind of walking you through this presentation. Let's see. All right, about me. I am a real estate investor, a key principal. I've invested in over 80 units across the Mid-Atlantic. Most of those investments are in North Carolina, and there are some investments here in the Virginia area. I've served as a co-trainer for Myers Method Multifamily Investing Education. And my current certifications, I do have a PhD in civil engineering. I am a professional engineer, licensed here in Virginia, and I'm a certified professional life coach. And so, you know, one of the things that we'll say, well, you know, who do you work for? What do you do? And why are you here? Well, really, I'm here because I'm an investor, just like you. I had to learn how to evaluate different multifamily investment options. And I want you to know what questions to ask and what other factors and things that should be considered. And so this is really a conversation, kind of a key principle to key principle or investor to investor, so that we can, you know, continue to have this discussion, be better educated, and make good, sound investment choices and decisions. So the agenda today is we're going to talk a little bit about why invest in multifamily, and then some just different discussions about what am I getting into, looking at what is your buy criteria. And then I'm going to talk through some personal examples of really what I mean when I say doing well while doing good. You know, what does that really mean to add to the list of things that you consider when you consider investing into multifamily? And so why invest in multifamily? Well, you know that housing is an enduring need. So regardless of what you do, you know, whether you are a police officer, a school teacher, whether you work at Walmart, CVS, whether you are a CEO, or whether you are in sanitation engineering, you need a place to stay. And one of the things that is true is that the supply of new homes and residences is really not keeping up with new household formation. So there are a lot of different things that are putting pressure on multifamily, but that pressure is good because that really means that there are opportunities that are out here. And so if we look at the demographic trends, so what are those demographic trends? You know, you look at, according to, data from the US Census Bureau, renting represents the most common form of housing for the millennial generation. And so if we look at that, there are people that have gone to school, they have some student debt, they're working, they may not have the money that's needed to be able to purchase a home, but they're putting strong demand on the multifamily and rental units. You also have baby boomers that are opting to rent. So now their children are out of the house, they're getting older, they really want to take some time to enjoy life, and they want to reduce the amount of work and effort that they do to the effort that they do to keep their lives. And so they'll continue to move forward with that. And then you have the workforce housing crisis. And I call it a crisis because it really is. I mean, when you look at, there are programs that are out there for affordable housing, but a lot of people feel as if they're caught in the middle. They make too much money to be considered for affordable housing, but they don't make enough money to qualify to be in the Class A or the premium type apartments. In a lot of your urban areas, they keep pushing the envelope. And when you look at new units that are being constructed, most of those new units that are being constructed are on the high end. I was at a conference and we were talking to some developers, and the developer said that, that 2x4 that he puts in the inner part of that apartment complex is going to be the same for a Class A property if it was a quote unquote Class C or B property. And if he can make more money, on a per unit basis by outfitting that as a Class A or Class A plus luxury property, that's what he's going to do. So there's really a deficit of safe, affordable housing, decent housing for our workforce. And again, when we see a deficit, we also see an opportunity. Multifamily investing also provides a hedge against inflation. You're able to offset cash flow and the income that's generated by that cash flow by using depreciation. And it really is an efficient method of growing equity and income. So there are a lot of reasons why multifamily investing is really key. And multifamily investing is a place where I've chosen to really focus. Anything outside of the normal things that I would do, stocks and bonds, but I'm really focusing now on multifamily because I believe that you can do well while doing good. And I'll talk more about that later on in the presentation. And so what am I getting? So one of the common things or questions that people ask is, what am I getting? Are you doing real estate, a hard or physical asset, or are you buying a business? And in the case of multifamily, you're buying both. So you're getting equity in that physical asset, but you're also buying a business, and that business is then valued based on the net operating income. And so that's really key when you're looking at and you're considering your investment options, when you're looking at the different deals that you may invest in, is it's not just the physical asset, but it's also the business that operates that physical asset that you have to be conscious of and look for. So when you think about valuation, you have a single family home. A single family property is valued based on the competing properties that are in similar size and a quality of construction. So what has been recently sold will determine how that property is valued. So you have less control over the value of the property. You can improve the value of the property, but that value of that property is really going to be impacted by recent sales. So when you look at multifamily properties, and here I'm talking about things that would qualify for a commercial mortgage. So you're talking about 5 units or greater. They're really valued more on the net operating income. And so that's your gross rents received minus your expenses. And so the location and condition of the property does play a role in the expected returns that are provided for investing in that geographical area. But a lot of that value is based on the value of that business that is operating that apartment complex. See, we got a couple of things in the Q&A. Let me check and see. All right, more chats. I believe that the presentation will be available and the recording is going to be published for playback later. I think that's one of the things that they do. And so I'm seeing you shaking your head. Yes, that will actually happen. So let's continue on. So there are different types of multifamily properties. A lot of times you'll hear people talk about the class of property. And so you have class A, class B, class C, and class D. So when you look at your class A, you're really talking about the cream of the crop. These are usually less than 10 years old and they're upscale. They're luxury apartments. The average rents are pretty high. They're generally located in a desirable geographical area. These are more white collar workers that live in them, and they usually rent by choice. Meaning they could afford to purchase a house, but they like the amenities of living in the apartment community. And so from an investment perspective, when you buy class A, you're really looking for appreciation. You're looking for long-term appreciation of that asset. Your cash flow may be a little bit lower or maybe non-existent to some degree in some of the class A investments, but you're really looking for how that property will appreciate over time. So when you look at class B properties, these can be anywhere from 10 to 25 years old. They're well maintained. They have a middle class tenant base, including both white and blue collar workers. Some are renters by choice, but others are renters by necessity. And so the cap rate, for these are a little bit higher than the class A properties, but they're lower than the class C properties. When you look at buying a class B, again, you're buying more for appreciation, but there generally is some cash flow that's happening on a monthly basis with your class B properties. So class C properties are those that have been built within the last 30 to 40 years. So generally these are blue collar workers and low to moderate income workers. And so most of the tenants are renters for life. With the exception of some tenants who are just starting out and are likely to work their way up to some of the other properties, the class B or class A properties as they progress in their careers. So a lot of the rents in these properties may be below market rent. And from an investment perspective, that's really attractive because that's an opportunity for you to improve that property and get the rents up to market. They also usually provide the ability for cash flow and can really be kind of the best of both worlds in terms of the cash flow, being able to identify things that can be improved so you can improve your net operating income and consequently increase the value of that property. Class D properties are built more than 40 years ago. These may be more considered the Section 8 or government subsidized tenants. They're generally located in your lower socioeconomic areas. And these particular properties may have long-term deferred maintenance issues. And it's kind of one of those things where you really need to have some experience on your team before you would consider investing in a class D type property. So what's your buy criteria? You heard me talk a little bit about cash flow, forced depreciation. You want to be able to look at equity growth from the mortgage pay down. as well as any improvements that are happening in the geographical area where you are. And so when you're looking at the market, the average, market rent is going to be below the median family income, times 30% of that. And so then when you look at the renters are over 30% of the households, you really want to be within 1 hour of the top 5 city by population that is within the state that you're looking to invest. We typically look at projects that are within 10 minutes from the interstate or a grocery store, and the local year-to-year rent increases at or above the regional average. And so we really, try to target those areas where things are moving and growing, but maybe the property that we're looking at hasn't quite hit the tip of that growth. We focused on units that are anywhere from 20 to 50 in terms of the number of units for any one particular purchase. But we really look at, making sure that the net operating income is over $100,000 and that the ability to drive expenses down to less than 40% of revenue. Current rents are below the market rents, and that the tenants are responsible for utilities, and it's a relatively low crime rate. And so these are all things that we consider when we're looking at prospective properties to invest in. These are all of the things, and there are more that I've had to look into as an investor like you, looking at various deal summaries, trying to understand, is this a project that I'm going to invest my money and my resources into? So part of the value proposition, you really have to be in a position to grow your net operating income. And so you grow your net operating income by being able to increase your income in terms of increasing rents or by reducing your expenses. And just because of how multifamily properties are valued, a small increase or reduction in your expenses can have a huge effect on your net operating income and the value of the property. So for this example, it's as if we would have a 100-unit multifamily apartment building. We did some improvements. We're able to increase the net operating income by $20 per unit. So part of that increase may come from a slight rent increase. It may come from a reduction in expenses, being able to operate a little bit more efficiently. But that income, net operating income, is going to increase by $2,000 a month. And that equates to about $24,000 a year. But depending on what the capitalization rate is for that area, the value of that property has now increased by almost $250,000. And so that one small, increase in net operating income can have a huge effect on the value of their property. And that comes into play to your exit strategy when you're considering to sell the property, when you're considering to refinance the property and remove the initial investments that you placed in the property. So these things, that the leverage that you're able to have in multifamily is much different than in your single family type of and residential real estate investments. So again, some of the ways that you're growing net operating income, you can raise the rent. You can look at carving out some reserved parking spaces. You can sell rental insurance. There are laundry centers, clubhouse rentals, garage rentals, extra storage. If they don't have internet and cable, you can be able to get internet and cable for the community, and that may be able to generate some additional income. When you look at reducing expenses, you can reduce the cost of your service contracts, shift the utility payments to tenants, install energy efficient systems in common areas. Any area where you as the owner or your ownership team expects to pay something for utilities, you want to make sure that you're doing things as efficiently as possible, because as I showed in the previous slide, a small reduction in your expenses on a per unit basis can really have a big impact on your overall value of your investment. So when I talk about doing good while doing well, it's really the whole concept of you don't have to drive every dollar out of the project as profits. We want to get a return on investment. I'm an investor just like anyone else. I want to make sure that I'm getting return on the money that is invested. But you really don't have to drive every dollar out as profits. You have a responsibility to provide a clean, safe space for people to live, and you can take care of your tenants and your investment partners. So you really want to be able to do both, and it's that combination that attracted me to multifamily. So for this next part, I'm just going to talk about examples. This example slides will be up for a little bit as I kind of walk through some of the experiences that I've had in this space. And so I started investing in multifamily properties approximately 4 years ago. And I remember going in to do for the due diligence on a property we were purchasing. I was looking to invest my resources, and I also served as a key principal on that investment. So as a key principal, then part of my balance sheet is up, and I'm signing part of a personal guarantee for that loan. And so we're looking at the units, and we're going, to each unit to inspect. And we run into some long-term maintenance issues that really should have been taken care of, and was really, to me, unacceptable for people to be allowed to live in those conditions. There was one young lady, she had, I want to say three kids. Two of them were still hip huggers. So they were still, kind of clinging to mom, and they were there. We went into the unit, and we walk in and we see that the sink is stopped up and no water's moving from the sink. There looks like some other water damage just coming down from the roof and into the kitchen. And the sink wouldn't drain at all. And the only way that they could drain the sink was to take, cups or cans and take the water out and kind of dump it outside. And, I'm looking at this, and I'm a father. I have two boys, and I'm looking at this as a parent, and I'm saying, it's really, I wouldn't want my children to have to live in those conditions. And I looked at my partner with the Myers Development Group, and I said, we can't do this. If I'm going to make this investment, if I am going to put my resources into this investment, then we have to make sure that we're going to provide a clean, decent place for people to live. I don't think anybody intends to be a slumlord. There may be some people that get into it that intend to be, but I don't think anybody on this webinar would intend to be. And so as you are looking at your options, as you're talking to your sponsors, as you are looking at your team, one of the things that I would challenge you to do is to ask them their thoughts about the community. What are they going to do to improve the lives of the tenants and of the people there in that community? And so I came away from that kind of with an overwhelming sense that you can do both. You can do well while doing good. And kind of my mantra out of that was, over the next 5 years, I'm going to improve the lives of over 500 families with my investment in over 500 units in multifamily. So we're about 1.5 years in. I'm an investor in about 90 units. We have another 120 or so that are in development and some other projects that we're working on. But we really want to be able to provide decent workforce housing and decent places for people to live. There was another unit, another time we were on inspection, and we're looking, and it looks as if there's mud on a little girl's sheets. And so, we're looking at the sheets and trying to figure out what's going on. And lo and behold, the sewer line had been backed up. This is a different property in a different unit. The sewer line had been backing up into the unit. And, when they would do laundry or when they would do other things, it was getting contaminated with the sewer water. And there's one investor or potential investor, that's kind of looking at it and says, well, it's a shame that people choose to live in those conditions. My pushback on that is that these people don't choose to live in those conditions. You as an owner, you as a key principal, you as someone of means can help influence the lives of other people. And if you have the means to purchase a multifamily apartment complex, then you also have the means to be able to lend a hand, to be able to provide an environment where people can live. It doesn't mean that tenants don't have a responsibility, but I will always place a bigger responsibility on those of us that have the means to afford those investments. And so, again, the values proposition, you really want to look to improve the resident living conditions. And you do that, part of exterior improvements, you make the place nicer. You really want the curb appeal to be there. And not only for the existing residents, but that plays a role when you're trying to get new residents into that community. You can do a community newsletter as part of your community outreach. You have your team or someone there that's in that local community that's really reaching out to those residents. You really want to be able to address the maintenance issues in a timely manner with care. And when I say with care, is you really want to be able to address it and not necessarily say, no one deserves to live in deplorable conditions. And so as an investor, I look at these things as part of my criteria in investments. And I ask the questions to the people that I'm investing with, what their take is on that. And we also look to use energy efficient appliances as well. And so my last slide, most of my investments are with the Myers Development Group. If you want to contact the president of the Myers Development Group, Jerome Myers, he's there. And myself, I'm James Bryant. There's our tags on LinkedIn. And let's see if any more questions came in. Okay, so someone asked, how did I learn this stuff? It really, for me, was, I had a good friend who was into multifamily properties, and he had brought to me a couple of different deals to potentially invest in. And I kept pushing back. I kept, I don't know. And then I started looking at the numbers and I said, well, this can really make a good investment. And I just started consuming books. I started looking at webinars, podcasts. He and I started learning things together. I don't do this full time. I have a full-time job. So when I say I'm an investor just like you, I'm an investor just like you. And I just wanted to take the time to learn more so that I would know what I was getting into. And so that's what kind of started on my journey. Jerome Myers and myself, we put our information together. He assembled information and we put together the Myers Method multifamily investing course where we kind of walk through some of these things. And so that's part of that learning process, is just needing to know, because I wanted to do well financially, but I also wanted to do good in the community. There's another question: which asset class has more risk? Is there a bigger reward? I think risk, all of them have some risk. What I would say is we focus more on Class C properties that may be in Class B areas, where we can be able to improve that property and get the reward of appreciation from increasing the net operating income. That's really kind of what we look to do. Someone asked, do we do new construction? Yeah, we actually are working on a project now where we're going to build, I think, 120 units on the east side of Greensboro, North Carolina. So we are looking at that. Most of the projects that we've done to date, or I've invested in to date, have been going in and purchasing existing properties. We've done a lot of our investments through normal bank financing. We've funded the down payment and initial resources through joint ventures and personal capital. We're looking at other ways in which we can engage in investors. And again, I just, regardless of what you invest in, what vehicles you use, I contend that you can make an impact on people's lives as an investor, even if you're not the deal lead, if you're asking the right questions. Another question, have you seen owner financing possibilities in this type of investing? Yes, we have seen owner financing. There have been owner financing possibilities in these. You find the right owner in a certain situation and it may be able to fund a part of the note. So typically what have happened is that the owner may not finance the whole thing, but they'll finance a portion of it along with the bank. And it makes your cost to close a lot smaller, the amount of money that you have to bring to close that deal. I see. Any other questions? I think that is it. I want to thank you for your time, and I appreciate it.
Thank you so much, James. We really appreciate your time. What I'd like to conclude here with is, if you're interested in learning more about self-direction and how you can possibly invest in multifamily, text NOW to 33339. Again, that's NOW to 33339. You can take a screenshot or a picture of this as well. And you can get our free e-guide. And also, if you'd like to schedule a consultation with one of our sales staff members, we're happy to do that. Give me one second. And that is our direct phone number here in the sales department. Again, if you have any questions whatsoever, please feel free to give us a call. And again, we appreciate your time today. Have a nice one.